Hello and welcome to Moneycontrol. It's the start of a new year, and this is usually the best time of the year to think about your investments, to think about your money box, and put a plan in action. And to help us, we've got just the expert with us in the newsroom today. Please join me in welcoming Ajit Dayal. He's the founder of Quantum Mutual Fund. Ajit had founded Quantum Mutual Fund way back in the year of 2006 with a strict set of principles and rules that many of us thought were way ahead of its time. But we are in 2022 right now. Quantum Mutual Fund has survived, has grown, and it has always stuck to its same set of principles and rules with which it was launched. Ajit is here to share his experiences of managing Quantum Mutual Fund, of leading Quantum Mutual Fund all throughout the way, and to also tell us basically what we can learn as an investor to become more thoughtful investors in the year ahead, looking at how Quantum Mutual Fund has managed its journey throughout. Hi, Ajit, and welcome to our show.
Hi, good afternoon, good morning, good evening to everyone, depending where everyone's logging in from. Thank you for inviting me, Shahzad.
So, Ajit, when your mutual fund, you launched your mutual fund in the year of 2006, and I remember you came with a very strict set of principles and rules, which many of us thought were way ahead of its time. You were India's first direct mutual fund, low cost mutual fund. You spoke a lot about transparency in distribution commissions, transparency in costs, not launching too many funds, and you've stuck with your principle, you've stuck on your road path, and Quantum has thrived, has survived, for so much longer than what many people in the industry thought you would. So can you just share us some of your experiences in leading Quantum Mutual Fund from the front with the set of principles and thought processes that you actually came up with?
So I'll go back a bit in history, actually, before 2006. So we started Quantum as a group in 1990. I remember, so the two things is that one, as a sponsor, Quantum Advisors, we're very well known in the international community as a long-term value investor for the allocations that the pensions, the foundations, the sovereign funds wish to allocate to India. When we brought our expertise and our desire to manage money for Indian individuals in 2006 under the AMC, we brought with us our partnership and our legacy from Tom Hansberger of learning how to manage money. And while I was with Tom as a partner, we were lucky to manage money for the Vanguard Group. And the Vanguard Group taught us that we must focus on what's best for the investors. So we took these learnings and we brought that to Quantum AMC. And when we launched, as you correctly said, there were 7 things that we were the first to do in India, including, as you said, the first sort of direct to investor, no load fund, the first to use a total return index as a benchmark, because the total return index puts the dividends back in, etc., etc. So there were 7 things that we did, and many of those things have been adopted by the industry, grudgingly, I must add, and have been made into law by the regulators. It's taken them over 12, 13 years to do so. So what we believe from a quantum perspective is that, yes, you must be high integrity, you must be transparent, and you must be able to give investors, your clients, your people who are giving you their savings, their hard-earned money that's being put into the stock market or liquid or funds or debt funds or whatever, in a way that allows them to reach their financial goals without compromising on the ethical framework of treating them as your client. And I think that's something which is a challenge for us. And I think the one message that's come to me clearly since 2006 is that it's going to be a lot harder than what I think it was, of course, when we started. And we still have challenges ahead of us. But at the same time, we have a lot of opportunities that I will talk about as we go on.
Some of the best global practices that you bought in India and Indian mutual funds industry when you launched Quantum Mutual Fund all those years ago. Some of the best global practices because you've been managing assets internationally and you brought that vision to India.
Correct. So, one of them, of course, was just the sort of fact that distributors, so if you look at the annual report of a fund, of a mutual fund, there was one person whose fees that were given or taken by that person was not disclosed. In the mutual fund annual report, you had the fees of the fund manager, you had the fees of the trustees, you have the fees of everyone's mentioned there. But the distributor's fees were never mentioned. And we said, why? Because the distributor is important. I mean, he's the sort of, he or she, they are the sort of last mile touch point between the AMC and, and the fund, and the investor. And so that was one big change that we brought in, that we said that we are happy to work with distributors, and we do work with them now, as long as they are willing to disclose the commissions that they have earned for putting a client into Fund A or Fund B or Fund C. That was a big one. And then, the other thing, which is still actually not there, and we didn't do it at the start, but we have done it afterwards, was to have a completely independent board of trustees. The trustees' role is to ensure that the investors in the fund are well looked after. What was stated and is spoken about in the in information memorandum at the time of doing the new fund offering, at that point in time, that everything that is there is complied with. So the trustee should not be someone from the AMC. And yet every fund house till today has someone from the AMC on the board of the trustees. And we think that is a conflict of interest, because the trustee doesn't work for the AMC. The trustee represents the investors. And, how will it be possible for a trustee to tell on a, in a board of trustees meeting to state that actually I'm not happy with point A or point B or point C, when the AMC's representative is sitting right there? It becomes more difficult. So, we were very keen to ensure that we had a lot of independence for the trustees, and that the trustees indeed could, mark to market what Quantum was stating in the offer documents, in the new fund offering documents, and what we actually were doing. And I think that's something which is yet to happen. The other part that I think is a bit scary from an investor's perspective is that no fund house is declaring the capacity of their product. Every product that is launched in the financial service industry has a capacity to it. So if I have a portfolio of shares and my portfolio is based upon certain principles, there's a capacity to that portfolio. If you give me too much money beyond that capacity, I will not be able to replicate the portfolio which has given the track record, which has encouraged you to invest with me. Because maybe the daily trading volume of that stock is such that I cannot buy any more of it. And every fund house, in my view, should declare a capacity. And that's something we've been doing too, talking about capacity of each of our different funds that are out there. So I
So
think
how do you define capacity in your do you define capacity in terms of the liquidity of the stocks that you pick, or do you define the overall AUM beyond which you will not manage this particular fund
no, it's
or any
you're right.
particular
They're
fund?
kind of related. So in the case of quantum, we said at the start in the launch, and that was roughly, if you look at exchange rates, we said that we will only buy shares of companies that trade roughly about 5 crores of
Okay.
rupees a day. So at that point in time, there were about 200 companies that traded 5 crores rupees a day on average for the previous 1 year. And now there are like close to 500 companies that trade over 6, 7 crores of rupees a day. We use roughly $1 million as the benchmark, if you will. So what happens is that then defines the universe of companies you can buy, because you have a volume criteria for the company you wish to invest in. And the volume criteria sits underneath whatever else you may have. You may then choose small cap, multi cap, value, growth. That's secondary. But the volume criteria is set. And the volume criteria of the underlying stock which you buy is important, because when you go to buy the stock, your action of buying should not influence the share price. On a very similar way, when you go to sell the stock, your action of selling should not influence the share price, which is why volume is important. But again, if you are an investor and you really want to trust someone with your money, you'd expect that fund house or that fund manager to think of all these things and build a product accordingly, not a product that becomes an asset gathering machine. where I want your capital, I want your savings, I want your money, and then what I do with it, in some sense, becomes risky. And I think that's where a lot of the trustees and the regulator needs to step in, is to not to worry about whether you've got a 50 crore net worth or a 100 crore net worth to launch an AMC, but what basis is that AMC built on? What are the principles of investing of that AMC? I think those are important things to be discussing and arguing about.
True. Right. 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 So, Ajit, now from 2006, let's just jump to the present times, 2022. If you see a lot of inflows, more than 70,000 crore worth of net inflows came into mutual funds in the last year, because the markets have gone up. You've had the Robin Hood moment after COVID-19 initial crash, market crash, and equity markets all over have gone up in the last couple of years. Now, what we've been observing is that a lot of new customers, a lot of new investors, first time investors have also entered the equity markets. What would you tell them? How should they become a thoughtful investor going ahead when they're starting their equity journey at these levels?
So I would say a few things. One is, I think the fact that people are investing in equities is fantastic. It's something that we've been talking about for a long time, and we know that equities, investing in stock markets, is one of the best ways to not only fight inflation, but to actually gain a capital appreciation to get you towards your end goals. So that is clearly a great sign that people are investing. If you're investing for the long haul, we call you an investor. If you invest for the short term, we call you a speculator in some sense. So if people are speculating, I really don't know, I have much advice for them besides be careful and don't speculate too much money. If you're investing, then clearly you need to understand a lot more about how your capital is deployed in the markets. And you need to go beyond the brand name to some of the points that we just discussed on what is the investor friendliness, if I can call it that, of the fund house. What is the understanding of the markets of the fund manager, not just which stock to pick and which stock to go, but in terms of but how do you service the investor best? So, a lot of words of caution for those who wish to speculate, and for those who wish to invest, as you would tell a teenage child, and that's part of the problem. Many first time investors today in the last 2 years since the pandemic are relatively young. And if you have a teenage child, you try to teach the teenage child from your own experiences as a parent. But we all know that teenage children have their own mind and their own thought, and they want to make the errors on their own. And to become a thoughtful investor, it actually takes time. You have to make mistakes. You have to learn from your mistakes. You have to make sure you don't repeat the same old mistake and you make a new mistake. And every time you make a mistake, you have a learning. And every time you learn, you become more thoughtful. So in so this is the start. It's like the kindergarten class of investing if you've just started investing. And it'll be a bumpy ride, but it's a wonderful, joyful ride. And if you're careful, you'll come out of it on tops. Again, it's the power of compounding. People forget that just by being in the index, for example, you could have made about an 18 to 19% compounded rate of return since the index was launched in 1980. Here I talk about the BSE 30 index. I'm more old school. I don't really follow the Nifty too much. I follow more of the BSE 30. So, you'd have made a 18 to 19% compounded rate of return since 1980. The index then was, 100, and today it's 61,000 on the BSE 30. And if you took the total return index, you add another 2.5% of that every year. So investing is great. And it's very, very good that people have come into the market, but I would urge them to sort of evolve carefully and, tread carefully.
So the power of compounding is what you are stressing on. I also wanted to ask you the power of asset allocation. I mean, there is a principle of rule that Quantum Mutual Fund has often spoken about. Can you enlighten our viewers and listeners as to how they could implement that, and what does that actually mean? How does it help you grow your wealth in a more systematic and sensible way?
So I was doing it pre Lehman. And I remember I wrote an article at the time when the Lehman crisis happened, and markets were down 50% and the currency rupee was down 20%. And I went for a holiday to the US and I wrote about it. And a reader wrote back saying, the markets have collapsed, the world has collapsed, and you're telling us you're on a holiday having a good time with your family. And I kind of stepped back and I said, I mean, didn't everyone think about the fact there would be, some sort of money to keep aside if things don't work out right for their investments? And I guess the answer was no. So ever since then, at at the bottom of this column I used to write, which is called the honest truth. I don't write it that much anymore, but I did write it till about 2 years ago. So at the bottom of every honest truth, there was a table, and that table was precisely this. And as we sort of formulated again within quantum, this is very important to know, quantum's first product was a value fund, because in the international world, that's what we're known as value investors. And then we added like blocks of a Lego game, right? You have the yellows and the reds and the greens, and you start making houses and everything from it. And we added building blocks very, very, very methodically from 2006 onwards. So we added the equity fund of funds, we added a gold savings fund and a gold ETF. We even have a Nifty ETF to track the index. And then most recently, we launched the Quantum India ESG Fund in 2019, July. And what we're really doing with 12, 20, 80 is telling investors, look, the 12 represents those many months of your monthly expenditure, which you keep aside in very, very safe places, which is a liquid fund. So if you have a pyramid, the base of the pyramid is the safest and the most solid part of the structure. You can always rely on the base to be there. The top may fall off, but the base will never fall. That's the foundation.
Absolutely.
And that's your liquid fund. And the liquid fund is where you keep, in the 12 simplifies that, 12 months of your expenses. So if I'm spending 10,000 rupees a month, then I multiply that by 12 and I keep 1.2 lakhs in a liquid fund. If I'm spending 1 lakh a month, I take 12 months and I put 12 lakhs in a liquid fund. Now that 12 can be 24, can be 36, whatever makes you comfortable. It's flexible. And the other part, everything else that's left after you've kept the liquid fund money aside, is split 80-20. 80% goes in equity funds, in a basket of equity funds, and 20% of the rest of that money goes into gold. And if you have that balance, you've got a fabulous pyramid. And at the base of the pyramid, as I said, is a foundation. So foundation is low risk. And when you have low risk, you have low return. And investors must understand that equation. They always ask about return. They must recognize that the more return you want. So as you go to the top of the pyramid, you go to equity. Equity is high risk. And if you take high risk, you must get high return. And to flip it around, if you are getting high return, you are taking high risk whether you know it or not. We choose 6 to 8 to 10 fund houses out there that we like. We like their style of management. We like their approach. It's not value. It's not ESG. It's different. And we sprinkle your assets, your savings into those fund houses. So we select those funds for you. We track them. We monitor them. We change them, etc. And right at the top, which is what we call play money, at the tip of the pyramid, that's money that you want to do for fun. You want to buy Bitcoin? Go ahead. You want to speculate on some venture capital investment that your friend's about to start? Go ahead. But put that much money, which even if it goes up 10 times in value, in price, will not change your lifestyle. And if you lose all of it, it will not change your lifestyle. On the Quantum website, you can play around with this. You can make your 12 into something else. You can change the 20 to 30, the 80 to 60, whatever you want to do. But the whole reason of the 12, 20, 80 is to force you to think. You must realize that things can go wrong in life. Things can go wrong in your job, in your salary, in your business, or just in your health. And when that happens, you need
So you
those
need to have some
emergency solid
emergency
money.
cash. Are there any more principles that you would like to share with us into becoming a thoughtful investor?
So, yeah, I think the risk part is important. Investment is something which you do to reach your journey. And I think some of the things that people sort of get lost into and sunk into, and then they get into a complete tailspin, is they're worrying about what did the neighbor do? What did their cousin do? What did they hear at the last, sort of dinner that they went to with the family or with friends? And there are people out there thumping their chest and saying, I did this and I did this. And that's fine. Let them do what they want to do. You have to tailor make your investments to suit your life, to suit your risk profile.
Ajit, Quantum Mutual Fund also was one of the first mutual funds to benchmark its own schemes with the total returns index. Eventually, that was adapted by the regulator, and all mutual funds are now supposed to be doing that. But what are the main benefits that come with it? And is it something that's prevalent elsewhere in the world that you sort of thought of adopting here when you guys launched Quantum Mutual Fund over here?
So if you look at the total return index, the reason it exists is because if you were as an individual buying shares in the company on your own, you would get a dividend every year. But now you're buying the shares through a mutual fund. So the mutual fund is getting a dividend from the company every year. And when it gets that money from the dividend, when it gets a dividend from the company, it reinvests it or gives it back to you, whichever way. But what you as an investor need to know is that if that money is reinvested, what would the return have been if the money was reinvested back in the market? And that's what the total return indices do. They assume that the index receives a dividend, and then the dividend received from the various companies that comprise the index are put back into the indices, back into the companies which comprise the index, and you get a total return. So it's a much more honest way for an investor whether the fund that they've invested in is able to outperform the benchmark or is underperforming the benchmark. So if you don't put this total return index, you're basically removing about 2 to 2.5% every year, because that is the approximate dividend yield of a typical stock within any of the indices. And as we're discussing this, I'd love to talk about the active versus passive theme that is taking hold in the world and in India. And how does that sort of fit into Quantum's plans going forward?
That was also what I wanted to also ask you when we came to TRI index and indexing. This whole wave of passive funds is sweeping over the world, and many people in India also are saying that passive funds are the way to go forward. I know that you have a history of Vanguard also behind you, but you've been in a very active investor. You've really laid down all the guidelines when your underlying funds actually pick up stocks, which you have elaborated in this talk. So tell us, what do you feel about this whole active versus passive dividend? I mean, we're quite interested in knowing your views.
So the active versus passive have multiple elements to it. And I'll begin with the global context and bring it to India. In the global context, active versus passive came about because Vanguard, John Bogle, the founder of Vanguard, the founder and the father of Vanguard, worked out that in the US, a developed economy, it became hard for an active manager to actively seek out companies that were doing better than the indices. And Vanguard was created on the premise of an index fund way back when. It made sense because what was happening in America, as happened in India, is that the fees being paid to the fund houses, to the various AMC equivalents, was far more than the benefit of being in that fund house because they were not able to outperform the index. So, in the Indian context, when you look at it, there's a big difference. The one commonality is that yes, AMC fees, AMC, the mutual fund expense ratios or the TERs have been very high, and those have now been sort of compressed over time, but they're still pretty high. So that's the common factor, that your fees are higher than the indices, than being in a passive index fund. The second part is that the index itself. So I'll put this in a little bit of sort of reference to context. Quantum launched its Nifty Index Fund ETF in 2009. And 6 months later, I sent an email to John Bogle and I put that in the domain. It's up there on the internet, asking him, like, I'm on my way to the US, would love to come and see you. And and I sent John Bogle the way the indices are calculated and the end result of the indices. And John Bogle wrote back to me that much as he does not like active investing, he would not invest in the indices in India. And he actually called it plain stupid. That's the phrase I think he used, plain stupid, that the way it's been constructed. I don't think the way the index is being constructed has changed between the year 2000 and 2009 and today. I think the indices are still being constructed the same way. John Bogle sadly is no longer alive. He passed on a few years ago. But the reason why he said that, if you do a simple chart and if you look at the Dow Jones 30, the S&P 500, the BSE 30, the BSE 200, the NSE 50, and we have that table at Quantum, we have done that. And you just look at the number of changes, how many companies are removed and added to the index year after year after year after year. The churn exists in India because it's a growing economy. So I would argue that while Quantum has the option for an investor to build a low cost passive portfolio, even in the 12, 20, 80 structure, there is a passive low cost option that will be made available in the next week or two. You can go for that low cost. But I would argue that you still need to have active management on the equity side. And then the question comes, how do you know which fund manager is good and which fund manager is bad? And that's where Quantum Equity Fund of Funds is doing that for you by saying, look, of the 500 equity funds out there, we will tell you which are the good 6, 8, or 10, and we'll ensure that your money is lying in sensible products and sensible funds with sensible fund managers. So we're helping you sift that.
In a country like India, and if you've seen, past 10 years or so, value funds have, it's been a challenging period for value funds. Ajit, how do you what should investors take from this challenging period to, I mean, i- is it that, value funds don't work in India, or as you said earlier, that, this is just a cycle and things turn, and eventually value funds also see good days and bad days?
Well, I think there's a fundamental shift. I think around the world for the last in since 2005. So over the last 16 years, value has outperformed growth for about 3 or 4 of those last 16 years. Growth has been a far better strategy outside India and in India compared to value. That doesn't mean that I'm giving up the value fund. And I think I'd like to differentiate here. Quantum Advisors, the sponsor of Quantum AMC, as I said at the start, we are known in the international world as a value manager. So when I walk into a pension office in the Western world, they have a big team, and that team has got $100 to invest around the world and in different asset classes. So they're investing in real estate, they're investing in private equity, in venture capital, in timber, in infrastructure, in equities and bonds, and around the world, so different geographies. So let's take the equity bucket. If, say, out of the 100, 50 is going into listed equities around the world, that 50 by their smart teams are allocated into growth and value and small cap and all. So they're making an allocation decision when they hire quantum advisors to do India value. They probably also have an India growth manager. They probably also have an India small cap manager. Value is one of the styles that they have within their complex structures. So in the Indian case, we don't expect a retail investor to have a chief investment officer and a whole staff to figure out how to allocate their money. So we built that CIO for them. The 12, 20, 80 replicates the allocation models that are effectively used by some of the pensions who've got a liability for their pensioners. Here, you've got a liability to your family, and you can go online and you build your own model. And the 80 solution that we have on equity, as I indicated before, through quantum equity fund of funds, you are buying different styles of management. The value fund gives you
Right.
the value style, and you're putting only 15% of that 80 into the value fund. So, as of today, the long term value funds in India ratio in India, of the quantum long term value, is at a 30% discount to the P ratio of the index against which we're benchmarked. So that itself is a protection, that if the market was to fall, there's some kind of protection because you're anyway cheaper than the market in terms of PE ratio.
Right, Ajit. So, of course, that makes a lot of sense. Ajit, now I wanted to ask you about your ESG fund. That's the topic that you brought up in our conversation. But what are the prospects of ESG fund? I mean, I know when you've been speaking about ESG on many platforms. What are the prospects for an Indian investor when you invest in an ESG fund? Is the Indian investor really getting an ESG product, or is it open to interpretation?
So we started ESG in a very naive way or a very innocent way in 1996 at Quantum Advisors at the sponsor level. Uh, when in our value fund, which was for international investors only then, we did put something called the integrity screen. And the integrity screen was to sift out, basically bad managements who we believe had done things that were not kosher or that were not reliable, that were against the minority investor rights, or in some cases had done something bad in the factory where they were and allowed certain things to be, rivers to be polluted, didn't worry about cleaning it up, and they kind of let it go and they didn't care. So we kind of made a black list, if you want to call it, and a filter of this integrity screen. Over the years, we matured and we read more about ESG. And by 2015, we built our own ESG scoring system. Now, we had a choice in 2013-14 of going out to external service providers to get their ESG methodologies, use their score, like you go to a rating company, you use the
Yeah,
score of a AAA, double C, whatever, and then decide
correct.
whether it works for your portfolio or not. So we asked them for sample reports of companies that we know failed our integrity screen. And we were, shocked and surprised, or whatever the word is you want to use, to see that the companies that we did not like, they actually had high ratings on their system. So the Quantum India ESG Fund that was launched in July 2019 is the first fund, A, that was launched from scratch, and there was not a name change. Two, it's the first fund that is built on our own scores and doesn't rely upon any external third party provider. And of course, when you compare it to the indices that are now being created around ESG, you'll find a huge difference. Some of these indices have certain firms in it which we don't own at all. And that creates a big disparity because we believe so. Beauty and ESG, in some sense, have now lie in the eyes of the beholder. And that, there will be standardization. There is a process going on for standardization of all of this around the world. And it may take 2, 3 years, but it will happen. And when there's standardization, you'll find that it'll become easier for an investor to understand what ESG is about. But I'd like to talk about the principle of ESG more important. Um, I think the principle is that all of us around the world have been very focused on GDP, in market cap, and profit. And as we're reading and as we're witnessing in our daily lives, there's a certain cost to society because it has led in some sense to equilibrium or sort of lack of equilibrium between the rich and the poor. There's actually more of disequilibrium these days compared to before. Societies are less stable today than they were decades ago, and at the same time you're looking at the environment and the planet around you in a broad sense. So the new three P's, as they call them, is planet, people, and profit. And the thesis that we have is, if a company is really a good actor, as it's called in this phraseology, if you do well to your staff, you do well to the society, you do well to the location where your factory is located, if you act in nice way to people working in a factory, the family, etc., and you do things for the environment, you probably will end up as a company that will survive longer and a company that will thrive longer. And that's the basic thesis, that you don't want to use your savings to support companies that are hurting society, that are hurting good governance, sorry, that are hurting good governance, or that are succeeding because they have certain clouts with governments. That leads to bad society. So it'll come back and haunt you one day. You may make a lot of profits from being in companies that are bad actors, but somewhere down the line they'll come back and hurt you because you'll be harming society and you're part of society. So I think that people have to recognize that even that 100 rupees can be very powerful in signaling sort of good action from different companies. And certainly from a quantum perspective, we put a lot of focus on that. We've done it since 1996, and now it's called ESG, and we're right there on the forefront of it.
And Ajit, you have a fund within the quantum mutual fund structure also on this framework, the ESG, the quantum ESG fund. Just roughly, I wanted to ask you, I don't want to take any names over here, but just roughly, I mean, out of, let's say, the top 100 companies, would you have a significant number of companies out when you run your ESG parameters on them?
Yes. The way the ESG scoring system is done, it's either a positive or a negative. So if there are 200 companies on the database, you only take the companies with a positive score, and the companies with a negative score are excluded. So we're not looking at the future per se. We're looking at the past track record of how companies have behaved, and we're giving them a score. There's over 200 criteria that are used in the Quantum India ESG process, which basically tries to eliminate those companies that are not good on ESG and ensure that capital is employed in those companies that are positive on ESG. And there's a difference between this and the value fund. So the value fund also looks at ESG scores, but in a different way. The Q India ESG fund, the Quantum India ESG fund, as I said, looks at historical data and says this is what you've done. You're good or bad, and you end up in the portfolio if you're good, and you're bad, you're out. In the Quantum Value Fund, the ESG process is I know this is bad, you know this is bad as a company, and I know this is bad as a fund manager. Tell me what you're doing to improve it. And if the company looks like they're in the right path and they have a desire to improve it, we give them enough leeway to swing or enough leeway to hang themselves, as a case may be, and see how they evolve over time. So it is possible that a company is disqualified in the India ESG fund because its past is poor, but it remains in the value fund, A, because it's got good valuation metrics, and B, because there's a path to improving ESG that we can see over the next 3, 5 years. It's a kind of different way that we use and kind of the same scoring mechanisms.
Okay. Understood, Ajit. Ajit, very quickly, I think we're running really out of time, so I'll just ask you one last question. What are your plans? You've successfully completed 14, 15 years in the Indian mutual funds industry. Where do you see yourself in the next 10 years, 10, 15 years? What are your plans for quantum? Where do you want to take quantum
Well,
mutual fund?
Quantum is a very, very small fund house today in terms of AUM. Although we do not benchmark ourselves as success or by saying that, we must be the top five. That's not what we do. But we were created, Quantum was created to act to be basically to make a difference to investors. Now, unless you can reach out a wide audience of people, you're not going to be relevant. It's okay to be relevant to few, which is nice, but we'd love to be relevant to a lot more people. So we would love, of course, to get more people involved in the 12, 20, 80 process. We'd love them to go to the website and try to understand what is it about quantum that syncs with them. Quantum is a very, very thoughtfully built AMC, and we'd love to have thoughtful investors come into the complex, understand what we've got, and then buy into our philosophy and certainly subscribe to our funds. That is eventually the aim, and that's the goal. The question is, is it going to happen in 3 years or 5? It will happen. That I know because we've got everything that's required for success. We've got the track record. We've got if you were on the sort of batting field, we've got the right posture as a sort of batsman out there. We're feeling great about it. And I think with the use of technology and the pandemic has certainly allowed more people the ability to confidently transact, on the internet, to put their money to work on the internet. Prior to that, the absorption or the use of the internet to transact was a little more shaky. Now people know they've been using the internet for 2 years, and they made a lot of
Yes,
financial
absolutely.
transactions on it. So we built the system, and it's 12, 20, 80 all the way.
Thank you so much, Ajit, and wish you all the very best. And let's hope the growth that you're talking about, the 10% of investors or thoughtful investors grows to, let's say, 20, 30, 40% sooner than later. But thank you so much, Ajit, for joining us and elaborately explaining us the quantum point of view, and also giving some really nice, valuable advice to our readers. I'm sure all our readers, viewers, listeners would have benefited a lot from your advice, Ajit.
Thank
Thank
you
you so
so much,
much for
Shahzad
joining.
and team, for allowing us to, reach out to those thoughtful investors. Yeah, thank you. Thank you very much.
Thank you. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.